Relative Strength Index, RSI, is another example of a momentum indicator. Similar to the stochastic, it helps us to see whether the market is currently in overbought or oversold conditions. Essentially, the RSI measures the underlying strength in terms of its average gains and losses over the last period. So what's the difference between the RSI and the stochastic indicator? Well, the RSI measures the speed of price movements, while the stochastic oscillator works best with inconsistent trading ranges. It would be quite safe to say that the RSI works better in ranging markets, allowing us to identify potential areas of reversals. Which indicator you pick would thus depend on what kind of market you're trading in. The graph shows us the RSI alongside a price chart. As you can see, the RSI is charted quite similarly to the stochastic indicator in that it is also plotted on a separate graph, seen on a separate window, and its values range from 0 to 100. However, we can also see that the band that exists with the RSI ranges, in this case from 30 to 70. These are the values that traders most frequently use. The way we interpret the graph, however, is fairly similar to the stochastic indicator. When the RSI rises above 70, it's a signal that the market is becoming overbought, and thus there's likely to be strong buying pressure, where an exit from this range, i.e. RSI dipping below 70 again, could suggest a potential reversal in price. This represents an increase in the possibility of price weakening, thus presenting us with an opportunity to sell. Conversely, when the RSI falls below 30, it signals to us that the market is becoming oversold, thus there's likely to be strong selling pressure, where an exit from this range, i.e. RSI rising above 30 again, could suggest a potential reversal in price as well. This represents an increase in the possibility of price strengthening, thus presenting us with an opportunity to buy. The RSI is a fairly simple indicator to watch. It consists of a line graph within a band that to look out for. In this section, we'll discuss how the RSI is calculated. Although this is not a prerequisite to understand fully before trading, it can be useful when you adjust the settings on the RSI. The formula to calculate the RSI is here on the screen. In this formula, G represents average gain and L represents a loss. This is calculated within a set period controlled by the length field. It is essentially the sum of the previous periods divided by the number of periods. The length of the RSI mentioned above refers to the number of periods back that the indicator will go for its calculation. Generally, for short-term trade ideas, traders will prefer a shorter length, whereas for long-term trade ideas, traders will tend to opt for a longer length instead. Other than the traditional 14-day period, there are also 9-day and 25-day periods that have become increasingly popular among traders. The source of the prices will also affect your final calculations of the RSI. You can choose to use any of the open, high, low, or close prices in your calculations, either in isolation or a combination of more than one. Now that you're clearer on what the RSI is and how it works, we can move on to the trading strategies which you can employ using the RSI. Here are 3 popular strategies used with the RSI: chart formations, support and resistance levels, and trading divergences. In the chart formation strategy, we'll try to focus on the common chart patterns that are formed in the RSI indicator and relate them to current price action. As you can see, the RSI indicator formed a double top before the price fell. This is because double tops are a bearish reversal pattern that form only after an asset reaches a high price on 2 consecutive occasions. Seeing this pattern in the RSI indicator should indicate to you that a downtrend is coming soon, hence giving off a strong sell signal. At times, we'll be able to find support and resistance levels on the RSI indicator much more easily than on the price charts themselves. Referring to the graph, you can easily spot a strong resistance level on the RSI chart appearing on the bottom portion of the chart, marked out with a red dotted line. When you relate it to the price chart, you can see that it makes sense. At the 4 different points in time where the same resistance level was tested, price is reversed as well. As with other support and resistance levels, these levels become stronger the more times it has been tested. In this strategy, we want to look out for any clear divergence between the action of price and RSI. This happens when price and RSI move in opposite directions for a period of time. Let's have a look at an example of how you can identify and trade divergences with the RSI. From the above picture, we can see that price is making higher highs, but the RSI is instead making lower lows, highlighting a clear divergence. This is a strong signal that there may be a market reversal soon, thus you should be wary of it when making your entry into the market. The RSI, similar to the stochastic, can also be adjusted to fit your trading strategies. You can choose to use 21, 34, 55 as your periods instead of a standard that you stick to. These show us that the best RSI period is actually a bunch of periods that we switch between. Similarly, with the stochastic indicator, we can find that the RSI also allows us to find hidden support and resistance levels which are not commonly used by the bulk of most retail traders. Using this example, we can see that RSI is not very responsive towards the standard 70% resistance level. However, if we plot our own resistance level, we can see that the price is reacting better against 52% resistance instead. The price tends to drop every time the RSI reaches the 52% level, indicating to us that this level is a good indication of a hidden relationship between RSI and price. In this case, you can see that it would make sense for you to enter the market here instead of waiting for the 70% level. As you can see, RSI reacted just as we had expected it to, and so did price, allowing us to benefit if we had opened a short position here. This shows how the RSI can be a very powerful tool for you to identify where hidden patterns and signals are in the market. If you learned something today, please like, subscribe, and hit the notification bell so you don't miss the next lesson about moving average, convergence and divergence, or MACD.